moved on to step 4 as we continue on the income statement. We've already spent substantial time studying revenue. We looked at revenue drivers, how companies make business. We're looking at what has happened with revenue over a period of time. We've broken it down into what's causing the increase. We've done some analysis on it. And we've also looked at the accounting for revenue. That is the most important thing, because everything else is based off of revenue. If you don't have revenue, you don't have cash and you don't have a business. So a lot of things, most things, are driven off the level of revenue or sales. So what we're going to take a look at now is the income statement. Take a look at the inventory, how that affects it, cost of goods sold, other expenses, and non-recurring. So the first thing is to keep the understanding of how inventory and cost of goods are related to each other. So if you're looking at how cost of goods sold works, you're starting with opening inventory, you're adding in purchases, discount, purchase returns, freight, less closing inventory gives us the cost of goods sold. So each one of these steps has different implications around it. Okay? When we look at cost of goods, it includes everything, all the direct cost associated with producing a good or product. So if we're looking at a manufacturing, something that is manufactured, then you're going to take a look at what are the raw materials that go into that, what's the labor that goes into that, and labor has a direct labor cost plus the benefits that go into that. You have a facilities cost because that's where you're making something. You have a packaging cost. So there's a lot of cost associated with making something. And we tend to see in looking at companies, those that manufacture, the cost of goods is much higher. But if you're going into a service business, it's a wee bit different, but you still have the direct cost of producing the product or service. So if we take the accounting profession and they generate revenue, how do they generate revenue? Back to the drivers. It's number of billable hours times the rate per hour. That's how accounting firms make money. Their cost of goods are you, the employee, who work hours, okay, and you get billed, the customer gets billed for those hours. But again, there's the facilities cost, there's the office costs. So there's some, a cost of goods exists for everything. The intent is to try to relate the cost of goods to the direct cost of doing business, of producing the product or service. Okay, we know there's indirect costs, and we'll talk about them shortly. Some companies do not include cost of goods because of industry tradition. Airlines, oftentimes, if it is a service business, it does not break that down, so we have to be aware of that. They still have those costs, and they are a direct relationship to the revenue, which is a function of volume and rate. There's two types of expenses, as I started to say, variable, and those are the ones that have a direct relationship to the revenue. Okay, that would be in the case of Geneseo Coffee Company, coffee beans, and in the case of Steel Dynamics, it would be iron ore or scrap metal. So these are things that will vary directly. They go up and down based on how much is sold. So there's a strong correlation between the volume metric of the revenue and the volume metric in the cost of goods sold. We then have fixed within limits. Okay, these are the property, plant, and equipment, things that you need to run no matter what. So if we look at the steel company, they're going to have a fixed cost of plant and equipment and such, irrespective of how much is put through that plant. Now, that's within limits. Once you reach the capacity of the plant, then it becomes variable when you go beyond a certain limit. So that's the cost of goods sold. And let's look at how inventory works at all of this. And it has a direct impact on the income statement. Now, we're going to start to look at the inventory having a number of components, raw materials, not processed into a product at all. These are the raw coffee beans or the raw input materials for Steel Dynamics. Work in process, that's where we've started. They're in process of being produced. It may take a few days or weeks for something to be produced. And then finished goods. So if we're thinking about this as a flow of a product, of a raw material coming in, it's then worked on where you add value. Adding value is adding cost, and then finished goods. Now, when we look at inventory, there's different levels of velocity or speed of turning the inventory into cash. Okay, so each one of these right here has a velocity or speed of turning into cash. And cash is so important. It's the lifeblood of any organization. So the speed by which it can work through these becomes important. The other thing is how valuable each step is. So we got the speed, the velocity. Spoilage or obsolescence may reduce value. The longer you have materials, inventory, it may spoil. Pretty obvious if you're in a restaurant business. If you don't sell fish at a certain period of time, it will spoil fresh fruits and vegetables. Obsolescence, the same thing. It may reduce the value. And think about this. If you're looking at a company and they have an inventory, is there a risk of spoilage or obsolescence that has not yet been taken into account? Is there a risk there? Or could be an opportunity based on, if you go back, this right here, that if you somehow would fraudulently keep that level up by having spoiled or obsolete inventory, your cost of goods sold could be would be lower than it otherwise would be. That's the valuation of the balance sheet. And today, with what we have going on with COVID-19 and all the changes, this is becoming a bigger issue. So take, for example, when this hit, a lot of companies just had to stop producing. So there's probably a little bit of everything here. But if you're in the restaurant business, there's no finished goods. In fact, you probably have a lot more spoilage. So we have the speed. We have to look at the spoilage or obsolescence. The longer the speed, the more cost associated with that and the more risk. Then we value inventory. And when we value inventory, we look at three basic levels. The traditional, first in, first out, which makes sense. If I'm thinking about it, you always take material in, you use the oldest one first. Specific identification, last in, first out. So we really got three methods. Depending which method is used, could result in different valuations. So what we have we're dealing with, remember, multinational companies, and with IFRS, has been this global convergence of standards. They've been coming together. But there are differences remain. And the biggest one is one of the big ones is with inventory. When we look at first in, first out, that produces a inventory valuation, if you look, based on the most current price. So that the inventory on a first in, first out would be valued closest to the last product first product, the last product that was received, at its value, the inventory would be recorded. When we look at the specific identification, and that's used for bigger items where it's pretty easy to figure out the cost. That could be with cars, that could be with trucks, etc. Now, with last in, first out, that would imply, if you're thinking about it, the last in is the first out, is that inventory could be understated and cost of goods overstated. Okay? This methodology is permitted under US GAAP only. IFRS doesn't allow for that. And a lot of this came back is it was the taxing authorities, the IRS, permitted LIFO, and it might have had a place a number of years ago, but what it often was the case, you use LIFO so that you could create a higher cost of goods sold, lower taxable income. Now, so you might say from a tax perspective, we do want to use LIFO. From an accounting financial reporting perspective, we want to use FIFO. So why just not treat it as a book tax difference? Well, the IRS specifically says if you want to use LIFO for tax, you have to use it for financial statement purposes. Unless a change in IRS rules limiting LIFO from US GAAP would in fact eliminate its use for tax purposes as well. So that's a difference that's been there. But we look at both sides. LIFO may distort the fair value of inventory, and it may not be the current or fair value of that inventory. Okay, and that's when we're looking at it, and we always looked at it from, historically a lot of focus has been on the income statement. Now with the advent of COVID-19, liquidity and balance sheet strength, the inventory does become more valuable. Now, a lender may look at inventory on a deeper basis too, because that may be their collateral for a loan. Okay, once we understand how inventory and cost of goods work, the next piece is how do we analyze the cost of goods sold? Well, you start by looking at the common size income statement and identifying the changes in the cost of goods sold or gross margin, because if you remember, revenue less cost of goods sold equals gross margin. And again, we want to look at a trend. What is happening over a period of time? Okay, so if it remains relatively constant, the depth of analysis you need to put on it is not as much. Okay, because that means there's a constant relationship between revenue and cost of goods sold. But if it has changed or there's variation, we need to take a much, much deeper look at it. And you need to understand the why, not that just it changed, but why. First thing that I would look at and I would suggest to you is, did the cost of goods sold go down because you use more capacity? Okay, so if you were operating at 80% capacity and you now moved up to 90%, those fixed costs aren't going to change. So your margin would go up, cost of goods sold go down. Sometimes you could add new capacity and that would cause the margin to go down. Capacity is a limit to growth. This is where you go back to your volume driver. How much volume can a machine, and machine can be people, places, or things, to produce that volume? Then, what else changed and why? Was there a change in the cost of inventory that wasn't passed through to the customer, thus decreasing the cost of goods sold? Or is it increasing? So we need to understand the why, but we start the process by looking at what that gross margin is, cost of goods sold. What's the trend? Is there a solid relationship? And that can help us evaluate the strength of the management team also. And here's just a fairly easy thing, and it's about the relationship and trend. The gross profit formula, net revenue less cost of goods sold, looking at it on a gross profit percentage formula. This is after we understand the revenue and we're following some sort of logic model, this is what we would look at next. So what can we interpret from this is that the higher the margin, the better. Is the trend going up or down? If we look here, uptrend, rising trend, falling trend, downward. Trends are important. We need to compare to industry. Is it better or worse? Why? Now, I've also provided some industry averages to you in the Excel document noted Stern NYU for industry averages. Please take a look at that. When we analyze gross profits, from an analytical perspective, is get to the facts. And we're trying to draw conclusions from this. And the first is we look at what's some of the reasons for higher gross margins. Efficient management. They know how to make the process work. Low cost of production, mainly where you may locate your facility, because different geographic areas may have a lower cost of production, both on cost of property and labor. But that can be reduced by new and improved techniques or technology, location and access to resources. Then you get into the product mix or premium pricing. Are some products more value added than others, or can we get a premium pricing? So both of those come into play here. And you would guess that if lower gross margins, when we're starting, and both of these are when we have to look at them in relative terms, relative to the trend, but relative to the industry. So if they're performing at an industry average, okay, but we try to get, are they better or are they worse? Obviously the opposite, higher cost of production. Is there excess capacity? A lot of times low gross margins are because there's excess capacity. Is management inefficient? They just don't know how to manage the labor. Is it the mix of products? Not properly pricing products. A lot of firms, small firms specifically, don't price their products based on costs. So they may not be making as much. So that sort of gives us a sense of gross profit. This is the second one. So take a look through the worksheet on this to understand how it works. And we'll pick up in a few moments when we talk about other expenses.